What's happening in Bitcoin right now is that institutions via ETFs are buying more than 100% of the supply. And they did it in 24, and they're going to do it in 25, and they're going to do it in 26, and in 27, and in 28, and in 29. The reason I think you can get to that $1 million price target is eventually you'll see the same thing that happened in gold, which is the price just goes parabolic. Once the sellers are completely exhausted, price skyrockets. I do think the next cycle in crypto is the cycle where Bitcoin catches up with gold. And then it's a question of how much bigger than it gets. Could 2029 be optimistic? It could be, but I think we have a very good shot at that. But I think the 4-year cycle is dead. I think we're in something like a 5 to 10 year institutional cycle. So there's cycles in everything, but I think we're in a new cycle. But it's this institutional cycle where we get up to par with gold. I think that's the cycle we're in.
Bitcoin is preparing for a supply shock that could rewrite the rules of the market. Institutions are no longer waiting for dips. They're buying more than 100% of the daily supply, hoarding Bitcoin through ETFs like it's vanishing gold. This isn't hype. It's happening quietly, relentlessly, and the pressure is building fast. When the last casual seller is gone, price won't climb. It will detonate. And when it does, people will look back at these levels with disbelief. Matt Hougan isn't throwing out wild predictions for attention. He's reading the tape. $1 million Bitcoin doesn't come from retail mania. It comes when big players with deep pockets start treating Bitcoin as untouchable collateral. We're not in the halving-driven bull runs of the past anymore. Those cycles are broken. This is something new. A longer, slower, heavier tidal wave of capital that doesn't care about charts. It only wants exposure before the next revaluation. While headlines fixate on short-term swings, the real game is elsewhere. The fiat system is bloated. Trust is cracking. And Bitcoin is standing alone as the hardest asset left. This isn't about speculation anymore. It's about front-running a monetary reset, and the clock is ticking. Let's watch clips from Matt Hougan's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Our 200K prediction, the sort of basis of that was there's this fundamental bull thesis of institutional investment and regulatory that was going to push prices up. We thought we would get above 100K and go to the next behavioral sell wall, which I thought would be 200K. So that's the next round number. I think one 50,000 foot way to look back at 2025 is to say, turns out 100K was a big behavioral sell wall. And it took us a year to get over it. I think we will get over it and move on. But I think I underestimated the number of people who would sell at 100K to get ahead of the 4-year cycle. And that kept prices from releasing from that gravity around there. I think gold racing far ahead is because central banks have been buying gold in size for the last 4 years. And eventually that excess demand overwhelmed available supply. I actually think there's a perfect lesson and a reason I'm still optimistic about that $1 million plus price target and that catch up. The central bank buying of gold started in 2022, and they bought a lot of gold in 22, 23, 24. It wasn't until 25 that we had that huge run up. And the reason was people were willing to sell to fill that demand for those first few years. But eventually we exhausted those sellers and the price went up. All the reasons you would believe the 4-year cycle it exists are either extraordinarily weak or actually negative. So what are the reasons people think it exists? One is the halving. The halving is half as important every time it happens. So it's just not that much supply being removed. So that's dead. The other is interest rate cycles. They went way up in 2018. They went way up in 2022. No one thinks they're going up in 26. Everyone thinks they're going down. So that's moving in the other direction. The third is blowups, FTX, Mt. Gox, ICOs. But in this new regulated era of crypto with ETFs and qualified custodians, the blow-up risk has been much reduced. The only other reason the 4-year cycle could exist that I can think of is chance. And I just think chance suggests, we got 3 of them. We're probably not going to get the 4th. At the same time, you have these one-time generational massive forces of regulatory improvement and institutional adoption. And I think they'll just overwhelm whatever lingering tiny forces persist from the old 4-year cycle. They're just things that matter more now than the halving. They're things that matter more than modest interest rate cycles. I just don't see it in 2026. I think it's up and to the right. There's too much institutional demand. I think we're in almost a heads we win, tails we win situation. I think either we have very strong economic growth, in which case risk assets do well and some liquidity gets sucked out of this, or we have a pullback in economic growth, in which case I think liquidity floods into the system because we've banned recessions globally. So I think either way, I think Bitcoin almost wins. And I do think we're in a monetary more liquidity cycle right now. The US has ended quantitative tightening. I know there's some differences in what's going on in Japan, but I think those trends paint in the same general direction. Yeah, I'll just add in one more note on that. Something has changed this year with crypto, though, which is with the advent of stablecoins and tokenization. I think traditional investors have started to be able to feel crypto. It's almost like they can touch it, like they believe it. And so I've found that in conversations, it's a lot easier to put crypto side by side with AI, right? Because they can now imagine it in their daily lives. That wasn't really true when Bitcoin was the only narrative that TradFi could get its mind around. Now that it can get its mind around stablecoins and tokenization, it sort of reified it and I think made it sit more evenly. So some of that maybe envy that we've had of the AI attention has been pulled back a little. Crypto prices are set by supply and demand. You have one source of new supply, which is blockchain rewards or staking, et cetera. And then you have this novel source of incredible demand on ETFs. And if we look into 2026, you can be very precise. At current prices, the Bitcoin network will produce $15.1 billion worth of new Bitcoin. ETFs they'll end up doing about $23 or $24 billion this year in 2025. And we think that will go up in 2026. So they'll far surpass it. Ethereum's an even stronger story, actually the strongest of the big three assets. Next year, we estimate about $3 billion in net new supply of ETH. We've done $10 billion in ETF inflows this year. We'll probably get to $11 billion by year end. That could be 15 or more, 20 billion next year. So you're talking about 5 times more demand than there is supply. That's an incredibly bullish story for ETH prices. And Solana, something similar. It's $3.6 billion. Solana ETFs have only been on the market since October, right? But in less than 2 months, they pulled in over $600 million. They'll surpass that as well. What this means is that there is this gentle tide consistently lifting prices up. And for what it's worth, you've seen that this year. The fear and greed index was at 10 and Bitcoin was flat. With the fear and greed index at 10, Bitcoin should have been minus 60. It wasn't minus 60 because there's been $22 billion of institutional money of suit coiners in those in those brokerage accounts. People are dollar cost averaging into stocks and bonds. It's just what they do. They don't even think about it. A lot of us save in our retirement accounts just automatically. The ETF makes it so easy. It gives us this institutional credibility. So I think that's exactly right. I think people will just continually buy it and buy it and buy it. The other thing I didn't mention about why ETF flows go up is the most obvious thing. And people always ask me, do you really think flows will go up? Ask any crypto investor, the first time they bought Bitcoin or ETH, have they bought more since then? I mean, no one goes 100% on day one. Why do we think it would be true for these ETF investors, right? They're going to leg in and in and in. So yeah, that story makes a lot of sense to me. Polymarket is opening in the US, right? The US is the world's largest market. It couldn't even invest during that previous boom. It's demonstrating traction in everything from sports to entertainment to economics, et cetera. It has huge investment, net new capital at which it can do outreach to people and build itself, build its understanding. And 2026 is an election year, and a lot of people are focused on the midterms. I think when you smash all those together, like you could see this go to $1 billion. I wouldn't be shocked to see that. So I think this one is pretty easy when you combine all those things together. I don't know if Ryan has a different take. A thing we don't talk enough about in 2025 in crypto is that we went from this one narrative of Bitcoin to 3 narratives: Bitcoin, stablecoin, and tokenization. We sort of just feel today like those narratives have always been there. But from a public perception, crypto was a one-trick pony until maybe this year. And now it's a 3-trick pony. One thing that I like about this prediction is crypto's going to be a 10-trick pony, maybe next year. Prediction markets is probably the 4th leg. but we're also going to see privacy and DeFi and DePIN and all of these things. And I think this is sort of the signal that we're expanding from these 3 giant narratives to something like 10. And I think that will make crypto significantly, more important, more understood, feel more real in people's day-to-day lives. I don't know. You can get tangential exposure by owning things related to stablecoins, because that will, of course, have to scale as Polymarket scales. You can get tangential exposure by owning layer 1 blockchains, because those things start to scale. But it's hard to get direct exposure without underlying exposure to the equity, as far as I know. I do think it's good broadly for crypto, but the specific tie-in, we're going to, get too in the weeds. The specific tie-in is
Right.
relatively limited. It just grows it out.
Bitcoin isn't riding hype anymore. It's riding structure. Institutions are stacking more than the network can produce, and that imbalance is quietly rewriting the market. The old 4-year cycle is fading, replaced by a deeper wave of adoption powered by ETFs, stablecoins, and tokenization. What happened to gold is repeating: steady accumulation, exhausted sellers, then liftoff. This isn't about timing tops. It's about recognizing that the future of money is being built quietly, and those paying attention are already positioning. Crypto is entering a new era. Stablecoins are challenging national currencies. On-chain vaults are reshaping asset management, and regulation may be the final unlock for institutional floodgates. What started as a retail experiment is now forcing central banks to pay attention and pushing Ivy League endowments to take action. From tokenization to prediction markets, the narrative has exploded. This isn't about hype anymore. It's about infrastructure, legitimacy, and momentum. The future of finance is already being built, and the world is starting to notice.
Well, we always love to throw in 1 or 2 predictions that have this sort of negative tinge to them, because I think it's important to be realistic. Everyone talks about stablecoins dollarizing the world from a positive perspective, because it is a positive story. You think about people in countries facing high levels of inflation, escaping that inflation with their savings into the relative stability of dollars, escaping the high fees that banks charge into the relative efficiency of stablecoin-based payments. That's a wonderful story from an individual perspective. But for the people running the central banks in that country, it's less of a wonderful story, right? It's capital flight, it's dollarization, it's escaping and putting pressure on the local currency. It's loss of sovereignty, it's loss of control over currency, which is like one of the fundamental things that many governments do. So I think not enough people think about it from that perspective. We've seen some emerging market economies form task forces to study stablecoins. They're now getting of a size where you're talking about hundreds of billions of dollars, where you're really talking about high impacts on commercial activity. I'm sure, David, you saw in Argentina significant stablecoin use. It's really penetrated there. You see it in other places. I think we might see someone blame stablecoins for harming their current. We might see countries try to ban stablecoins. I think we've gotten to the size that we're big enough that we matter. And I think you'll start to see the other side of that come into the equation. So an on-chain vault is like a fund, but it exists on-chain. So users will deposit assets, typically a stablecoin like USDC, into a vault. And then third-party managers, we call them asset managers in TradFi. They're called curators in crypto. It's a pretty highbrow term. Curators allocate the funds in various ways, often to generate yield, but sometimes just to generate total returns. In the same way, a traditional asset manager like a BlackRock will take in dollars and then invest in yield-bearing bonds or invest in stocks that might deliver total returns. A vault curator will take in stablecoins and invest in yield-bearing DeFi protocols or generate total returns through some sort of strategy. We think it's the way that asset management will exist when we are in this fully on-chain world. We think Bitwise will be a vault manager as much as it is an ETF manager. And vault sort of emerged in 2024 from effectively nothing, and assets ramped to about $2 billion. They continued to run up in 2025. They hit almost $9 billion. That's a pretty reasonable size. And then they washed out in the October volatility spike, and a few of the poorly managed strategies by weak curators had issues, and AUM is down. We think they come roaring back. We think large, high quality, professional crypto managers will come into the space as curators And this will be seen as an institutional way to get diversified exposure to yield or total return. I love calling them ETFs 2.0 because, of course, ETFs were a disruptive technology when they were created in 1993. They replaced effectively mutual funds, which is how people invested until ETFs came along. Now ETFs have replaced mutual funds. I think the next version of that is vaults. Someday we'll be sitting here talking about multiple trillions of dollars in vaults. Today there's $20 trillion in ETFs. Someday we'll get to $20 trillion in vaults. I think it's that big of a deal. It's a really big idea. The Clarity Act passing would be like a starter's gun for ETH and SOL to run into trillions of dollars of value. What we have from a regulatory framework in the US right now is we got the Genius Act encoded, written in stone. Stablecoins are regulated. They can exist. They can be used for payments. The rest of the regulatory progress we've made over the last year is written in pencil because it's all regulatory decision making and it could be reversed in a new administration. So we feel really good about the state of regulation, but that could be reversed. And that prevents some high quality entrepreneurs, some high quality VC, some Wall Street firms from building on this because you're not building on the most sound, robust foundation. If the Clarity Act passes, we have the full regulatory spectrum to build the future of finance, to build a bankless world, to build real DeFi disrupting all financial action. And I think you're going to see just an incredible explosion of entrepreneurial activity, of Wall Street investment, of investor interest, of 1,000 different themes. So if we get it, we're going to see this massive explosion. I think we push really higher. If we don't get it, I think it'll be a real negative shock to the ecosystem. I think the market expects us to get it. There's some risk that won't happen. And I think it would be a psychological setback. I'm not saying that ETH and SOL can't get to all-time highs if we don't get the Clarity Act, but I do think it will be a big setback and it will take some time for the industry to work through.
Are we going to get the Clarity Act done next year?
Yeah, I think it's a great question. I think we have better than even odds, but they're not at 100%. To some extent, it's become personal. To some extent, it's hung up on how many limitations there are on White House activity in the crypto market. And that makes me worried because that can be a place where the two parties just butt heads for reasons that have nothing to do with what's best for America and instead are sort of personal bias issues. I'm hopeful we can get it through. If you had me to put odds, I'd put it like something like 60%. Some people say it's a little bit higher than that, but it's not a guarantee. We need to continue focusing on it because it's really existentially important. I love how you framed it as sort of the regulatory pillar supporting tokenization. I would add DeFi underneath that as well. And I think if it passes, it's going to be great. There are 8 Ivy Leagues. 2 of them are invested in crypto, Brown and Harvard. The reason it matters is not just because they're large. That matters. They manage whatever, $60, $70 billion in assets. That's a big deal. Maybe more. Actually, I think more. I just don't have the numbers in front of me. But the reason they matter is because they set the tone for institutional investors. For instance, we all think of hedge funds as like one of the primary way institutions around the world invest. And that is true today. But it wasn't always true. 30 years ago, hedge funds were this like tiny corner of the market where family offices and a few rich guys invested. And then Yale started investing a huge amount of its portfolio into hedge funds. They delivered exceptional returns. David Swensen became like the best investor in the world in most people's eyes. He wrote a book that everyone read. Every major institution wanted to follow the Yale model, which is what it was called, which was to concentrate in privates and hedge funds. And that industry became a giant industry. I think if we get half or more of the Ivies investing in Bitcoin, it validates it for every institutional investor. The fact that Harvard allocated was brought up in my conversation with a sovereign wealth fund today. The fact that Harvard allocated was brought up the last time I was on a national accounts platform. It really does matter because it's seen as a leading light. So this is a big deal.
While headlines scream about a possible crypto crash and predictions of Bitcoin plunging back to $10,000 flood LinkedIn and analyst reports, what's unfolding beneath the surface tells a different story. The current market pullback from $126,000 highs to around $85,000 has sparked fears, but those watching long-term structural flows aren't panicking. they're buying. And more importantly, they're building. Matt Hougan pointed to this shift months ago. We are no longer in a hype-driven cycle. We are in an era defined by regulatory clarity, institutional adoption, and long-term infrastructure growth. ETF flows are climbing. Tokenization is expanding. On-chain vaults are gaining traction. Even Ivy League endowments are quietly validating crypto as an asset class. These are not signals of collapse. They are signs of maturation. Yes, liquidity may tighten. Yes, the Fed could spook markets in the short term. But the idea that Bitcoin will mirror 2007 equities ignores how fundamentally different the crypto landscape has become. Unlike meme stocks or speculative junk, Bitcoin is increasingly being treated like digital gold. And like gold, once supply is exhausted and demand remains steady, prices do not crash. They reset. The real risk is not in temporary corrections. It is in missing the reaccumulation window before the next institutional wave hits. Short-term noise is clouding a long-term transition, and when the dust settles, the market will look back at $85,000 not as the top before a crash, but as the pause before Bitcoin's next massive repricing. The money printing may slow, but conviction around hard assets is just getting started. As we wrap up, do you agree that the 4-year cycle is dead, or is it just delayed? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.